Joining me now to discuss it all and to work through some of the most important points of what Jay Powell made, Peter Schiff, Euro Pacific Asset Management chief economist, market strategist, and Fed skeptic. And we've got Citi Global chief economist Nathan Sheets, who previously worked at the Federal Reserve for 18 years, serving as director of the Division of International Finance and advising the exact committee that makes decisions, the FOMC. Nathan, I'll begin with you. We are now hitting a fresh new low for the Dow down 709 points. What do you think the markets are, well, I don't want to say regurgitating, but trying to get out of their system that they dislike the most?
Well, I think Jay Powell was very clear about the risks facing the economy at the moment. And first and foremost, of course, that's uncertainty about the situation in Iran and where the oil price is going. But as you pointed out, there was a lot of discussion in the press conference about the path of inflation. And Jay Powell made clear that the FOMC was prepared to do what was necessary to hit their 2% inflation target. And all of that's occurring at the same time when the jobs market is looking weak. So there are risks on the horizon. Underneath it all, I think he was fairly comfortable that the economy would land in an okay place, but lots of risks around that.
Well, can we bring up the soundbite number one? Because he was asked multiple times about how long the oil shock might last. And I think that is something our investor audience needs to hear what he said about it. Here we go.
Nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. To your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one because we just don't know.
SEP, of course, standard economic projections, which only come every couple of months from the Fed. Peter Schiff, let me bring you in on this. He, in essence, is talking about the new unknown. The previous unknown, which is still kind of there, are the effects of the tariffs causing increases in goods prices. But tell me what you think about his assessment of the oil shock, and how do you think it's going to work its way through the economy?
Well, his assessment of the economy is completely wrong, irrespective of what's happening with oil. He doesn't understand the economy, doesn't understand inflation. I mean, first of all, the gold's move down started before the Fed announcement and the press conference, and it happened in response to the much hotter than expected February producer price index, which spiked up 0.7, which annualizes to 8.4%. Annualized. We have a huge inflation problem that the Fed is not acknowledging. And the fact that the Fed is not going to cut rates this year is not what's bearish for gold. What's very bullish for gold is that inflation is running away and the Fed is not going to hike rates. Every single rate cut that the Fed made since the summer of 2023, when the Fed funds was above 5%, every rate cut was a mistake. The Fed needs to hike rates immediately, not by a quarter point, but by hundreds of basis points. They're way behind the curve. They need to go back to quantitative tightening, but they can't because the economy is a disaster. Look at Q4 GDP growth of just 0.7. We're headed for a recession. In fact, for all of last year, GDP grew just 2.2%. That's 20% below the 2.8% from 2024, but it is slowing fast. And all of this was before the war. Now that Trump started a war, the situation is going to get a lot worse. The national debt just went past 39 trillion, I think, yesterday. I think we're going to blow through 50 trillion over the next 3 years because recession, rising interest rates, war, and a housing crisis are going to send our budget deficits through the roof. These are real serious economic problems. Powell said it's nothing like the 1970s. And in a way, he's right. It's way worse than the 1970s. And the Fed is one of the main reasons that it's going to be so bad.
Okay, well, that brings up the point that the entire group felt that GDP this year would be 2.4%. That ticks up, Nathan, from 2.3%. That's nowhere near the doomsday scenario that Peter Schiff talks about. Where are they getting that number? Because there are a lot of people out there who feel more like the 0.7 part of GDP.
We've, in recent years, as Chairman Powell emphasized, seen a very resilient U.S. economy. And lots of challenges in the economy has continued to grow. And candidly, I would still lean toward a fairly optimistic outlook for growth this year on the back of a solid consumer, ongoing significant AI investment. And then in addition, the U.S. corporate sector is lean, mean, efficient, and globally competitive.
Okay,
There's a lot to like in this
Why then
economy.
do we need rate cuts, Nathan?
I think the argument for rate cuts from here is one that's pretty tenuous. And the best rationale that I can come up with is that in the Fed's mind, the Fed funds rate is still a notch above neutral.
It was interesting. There was only, Peter, one dissent this time. Last time around, there were two, right? There were two or three. I think we haven't seen three dissents since 1988. I almost expected we would see three, the three people on the Federal Open Market Committee who were appointed by President Trump. And that would be Waller, Bowman, and Myron. Just this time around, it was Stephen Myron who was the one dissenter. He wanted to see a cut of now just 0.25%. In the past, he had wanted to see a bigger cut.
Yeah, well, the problem is none of the FOMC members are voting for a hike. And that's what we need. But they're afraid to deliver a hike because of what it would do to the markets, to the economy. You know, when you talk about the resilience of the American consumer, it's all based on the ability of the consumer to go deeper into debt, to buy more products he can't afford and that we didn't help produce. And it's all about leverage. And so the Fed understands this. And in fact, if the Fed starts hiking interest rates, one of the most impacted is the U.S. government itself, because the cost of servicing the debt explodes as interest rates go up. Meanwhile, look at the housing data that came out today. Home sales are collapsing because real estate prices are at least 30% overpriced nationwide. And we are on the cusp of a decline in housing prices at least as great as the decline in 2007, 2008 that precipitated the 08 financial crisis.
It's funny.
And I think the economy is even more leveraged now than it was then. And we could have a bigger financial crisis if the Fed did the right thing. Now, when the Fed does the wrong thing, we'll have something worse.
Diving, folks. We've got Toll Brothers, Lennar, NVR, D.R. Horton, Pulte Group, everyone down anywhere from 3 to 2%. ITB is right now, that's the Home Builders Index. That is one of the worst performers right now from a sector perspective. And it's down about 2.6%. I think consumer discretionary is among the worst. But that said, Nathan.
Yeah, look at Fannie and Freddie. Wait till you see the losses that are coming for the GSEs. This is going to be 2008 all over again for them.
Well, do you agree with that, Nathan? Is it that bad?
It's clearly the case that the housing sector is the softest part of the economy. But I think we've seen over the last few years the U.S. economy grow at a solid pace, notwithstanding that softness in real estate. And broadly speaking, I think that's my baseline for the year ahead, and it's the Fed's baseline. But certainly housing is soft, and it's a risk.
Dow Jones Industrials now down 721, low of the session. Just a few minutes ago, a loss of 735. One of the most interesting parts of the entire news conference was when Fox Business's Edward Lawrence asked the question that was sort of that 800-pound gorilla of a question in the room. What would happen when Jay Powell's term is up, which is this coming May? Is he going to leave? Of course, the Department of Justice has filed to get a subpoena, which was rejected by a judge last Friday, to investigate Powell for some comments he had made during some testimony regarding the cost overruns of the Fed headquarters. Let's listen to his response to Ed Lawrence's question.
On the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet. And I will make that decision based on what I think is best for the institution and for the people we serve.
Right now, he's got the upper hand, does he not, Nathan, when it comes to this face-off against President Trump and Jeanine Pirro? But I talked to a lot of lawyers. They feel that the fact that a judge said you can't even subpoena just to do an investigation into something like this may not hold up in an appeal. That why shouldn't the government be able to at least launch a deeper investigation via subpoena?
Yeah, clearly, Chairman Powell has the advantage of incumbency. And if Congress doesn't act, he will continue to be a very persuasive and leading voice at the Federal Reserve and on the FOMC. But one can flip that around and say, it seems to me that gives the political process, the White House and the Congress extra incentive to resolve this situation and to get Kevin Warsh confirmed.
Really quickly, Peter, I don't want to ignore the fact that the new unknown, as we referenced it, is the new conflict in the Middle East. What do you think investors should be doing at this time, knowing that oil could be extremely volatile?
Well, I have a lot of oil stocks. Maybe now is not the greatest time to buy them. I think the gold stocks today, it's a great day to buy gold stocks, a great day to buy gold. War is inflationary. It's inflationary because war is financed through inflation. This war is going to be very expensive. The budget deficits, which were already skyrocketing, are going to be even higher. The Fed's going to have to monetize even more government debt to pay for it. So inflation is going to run out of control. This is extremely bearish for the dollar, despite today's pop, and it's very bullish for gold. So people should be selling U.S. stocks and bonds. In fact, U.S. stocks are barely down today. They should be down a lot more. They should have already been down more. So people should take advantage of the fact that the stock market is still so overvalued by selling and getting more money out of U.S. financial assets, out of U.S. stocks and bonds, buying gold, buying silver, buying mining stocks, and get prepared for this, because this is massive stagflation. And it's not just stagflation. It's going to be recession and high inflation combined, much worse than what Powell believes happened in the 1970s.
Well, let's see. We will watch it. There have been a lot of calls over the past couple of years for recession, did not materialize. We'll see what happens. Peter Schiff, Nathan Sheets, great to have you both. Very lively discussion